This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello, and welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name's Andrew Page, founder of strawman.com, and today I'm joined by Mr. Claude Walker from ethicalequities.com.au. How are you, Claude?
I'm well, thanks, but unfortunately today we're missing Matt from mattjoss.com.
Matt not feeling too well today.
Yeah, that's a real pity. We'll definitely miss him. But we've got an exciting lineup of topics to talk about. Andrew, what are you going to talk about today?
Yeah, we do. I thought I'd do a bit of a highlight on integrated research, a stock that's really been in the doldrums for quite a while, but then had a really big pop last week. So it looks like things might be turning there. And
yeah, and I bet you wish that you'd done your scorecard review after that pop, right?
Yeah, we talked a bit about that, was it last week or so? So that's certainly helped push things along and a few other things moving in the right direction. But hey, that's volatility, and that's what you get with small cap investing, right?
Yeah, well, that happens, and the market doesn't always play ball.
Yeah.
So I'll be talking about the subject of the most recent hidden research on ethical equities. That's Xref. The ticker is ASX XF1. Now, that research was written by a good friend of mine, Matt Brazier. So all credit to him on doing the hard yards on that one, although I should disclose I own the stock and I look forward to giving you an outline.
Okay, well, it sounds really interesting. And we thought if we have enough time without Matt to slow us down with all his usual waffle, we might actually get through. Joking, Matt.
Yeah. Don't worry, he's the most concise of the three of us. The wisest of the monkeys. Knows that.
But we might get through to some listener questions as well.
Yeah, we've been looking forward to that actually for a long time.
So let's kick it off. Integrated research. So let me give you a very brief overview of this business. We like to talk tech. Our listeners know that we like to talk tech, but this is an old tech company. These guys were formed in 1988. They've been around for a very, very long time.
Starting from the beginning.
They are the absolute global leader in their field, 1,200 customers globally. They're in 60 different countries. You know, I think it's like 125 of the Fortune 500 companies are customers of theirs. The software in question is what they term experience management solutions, which sounds like a fairly airy-fairy kind of term, but this is software that monitors really vital client systems. It ensures that they're operating properly, it identifies any issues, it predicts disruptions, and then provides like guidance so they can rectify any potential issues. So if you're a big company and you've got some really important software that you need to ensure is running really, really well, you need to have this kind of stuff. And so they've been doing that for ages. The shareholder returns long-term are absolutely insane. If you bought these guys 10 years ago, you would have compounded at more than 30% per year over that time frame. Over the last 5 years, it's about 17% per annum. Having said that, shares did halve from a record high that they hit early last year, and they just kept on going down and down and down.
And so why was that? I'll be the resident cynic as usual.
That's a really good question. I think there's a combination of factors there. I think this was a company that, as I said, the shareholder returns have been great. That's been driven by phenomenal sales and earnings per share growth.
So why is it down? Oh, the shareholder returns have been great.
They have been great. No, context, Claude. It's all about context.
Okay, so for a bit of context, they
were performing really, really well and have for a very, very long time. And the market had ascribed to them a growth multiple. They came out with their full year results last year and essentially revenue and profit was flat. So when you have a company that's priced for growth and then you see things stall, the market reaction can be pretty brutal. Now, add to that, there's a couple of more wrinkles here as well. They have these reseller partnerships with these other big organizations. Avaya was one of them. They got into Chapter 11 over in the US, so that knocked their sales back a heap. By the way, they've since restructured and they've re-signed a new reseller agreement, so that's back up and running. There were some troubles in the European operations. They just self-admittedly not executing well. We've had this long-term founder who has stepped down.
Here we go. And a little more on that, please.
You're such a cynic. You're such a cynic when it comes to people. This was telegraphed a long time in
The
advance.
stepping down, maybe, but if I recall correctly, there was like the founder who was also the chairman, I want to say.
Yes, he was the chairman.
Yeah, and he sold...
Steve Kalalia.
Yeah,
If I'm
so
pronouncing that right.
now, not to take anything away from the many years of good returns building the company, etc., but it looked to me, and like to a lot of other people, like the order of events were not what I look for in a company. And I think the order of events were, please do correct me if I'm wrong,
Yep.
is he sold some shares.
He did early 2018.
How many shares?
About 15 million shares. So he owned 48% of the company.
Yeah.
Now he only, quote unquote, owns 40%.
But how much was those 15 million shares worth?
When
he sold
it
them?
would have been 350 or something.
Yeah, so
per
like
share at
over
the
$40
time.
million worth.
Oh, it was a very big chunk of
Yeah,
change.
so he cashed out in a big way.
He did.
And then when...
Well, he's got 40% of the company.
Yeah, but I'm just wondering now, then what was like was there an upgrade after that?
No, there wasn't.
Oh, okay.
Yeah.
So was there a downgrade after that?
Well, this was pre their flat result for 2018. Oh, it gets better, Claude.
What caused the
see
share
you-
price to like tank?
Okay, so I think it was largely a consequence of a growth company being revalued. A big part of that. You're going to love this. The other part of it was we had a CEO, John Merikovsky, who had only been in the role for about 18 months, and he stepped down towards the end of last year for quote-unquote family reasons.
Wait, so you've got the chairman founder selling, and then you've got the company falling short of expectations.
Yes.
Right? And I honestly, I had in my mind, and this may be wrong, but I had in my mind that there was like actually a downgrade of guidance or something like that.
No, it was just, well, heading into the full year result, they did say that things are going to be flat, and they delivered a flat result.
Yeah, right.
Okay.
Anyway, so
And this is the problem, right? So and then last week, what caused a 20% plus surge, one day pop in the share price, was that these guys updated the market, and they said, actually, we're going really well. We expect first half revenue to jump somewhere between 7 and 11% because of the operating leverage in the business that software companies tend to have. That means that the pre-tax profit is going to be somewhere between 20, 25, 26% higher in the first half. That, my friend, is a very, very strong quantum of growth. And importantly, too, the European operations, they made some mention there that things are back on track. So we're going to get the full detail, I think, mid-February when they actually release their full audited results. But the update to the market really sort of suggested that, hey, actually, things are back on track.
Okay.
We are back on a growth pathway.
Okay, I've got the order of events here. So in March 2018, that was when the big sell down came.
Yeah, we would
that
have been
was
around there. Yep.
$57 million worth of shares.
Mhm.
And then we had in July, 4 months later, a profit guidance was given.
Mhm.
And on that day, in July, the share price moved from $3 to $2.50.
Yeah, it was a big drop.
So I'm
Yeah.
assuming that was a disappointing guidance for the market.
Yeah, as I said, the market was expecting
Yeah.
growth. Now,
And then the chairman retires, and you have a CEO quitting. So you can see
Yeah.
why the market got very negative on this.
Yeah,
Now, maybe
totally.
they got too negative, not to take that away from you. When did you add it to your
I
scorecard?
only added it to my scorecard about a month or so ago.
Yeah.
And this is my point.
But
Look, when
so
you
this
see
is the problem is, like, do you think... So for me, and maybe this is where there's undervaluation, but for me, as with a lot of other people, I know a lot of people that after that first July guidance that disappointed, they said, you've got the sell down and then you've got the disappointing guidance, and that was enough for them, and they got out at 250, and that turned out to be the right decision for them. They could buy back today at 220.
Yeah.
So, yeah, to me, I wonder if it is still good value at 220.
I think it is. I'd encourage listeners to jump onto my Strawman profile. I've got a valuation of around about 255 or so, and I think that's pretty undemanding as well. I mean, let's just step back for a second. Now, consistently, when they issued that guidance, they always said these were short-term issues. The business has never been in a stronger position. They've got zero debt. There's $11 million in cash. 95% of their revenues come from overseas, and 88% of those revenues are recurring in nature. So this is a business, again, with a wonderful pedigree. And these are the kinds of things that I definitely keep on a watch list. Businesses that have delivered incredible shareholder value for many, 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 many years. Founder-led, massive inside ownership.
Anymore.
And totally, did they deserve to be trading at $4 at the time? No, and I didn't hold them or recommend them at the time.
This is where your contrarian move has paid off. In that,
so far
it would appear that the bad news was all out.
Pendulum, to my
did you actually buy, or did you just?
I wish I'd bought some. So I'd recommended them on Strawman. Having said that, my situation at the moment is there's a lot of my capital sort of going to support the business. So there's that consideration. So I'm not actually buying much at all at the moment. Well, I thought we were going to go an episode without mentioning Catapult or Pro Medicus. So I think it's a very interesting thing to note that with the market, the pendulum swings both ways. Like the market gets excited and the valuation gets a little crazy. The market gets disappointed and things get a little bit silly. And when you have a business of such high quality, it's such a defensive business and all the other characteristics I talk about. And it just got to a point, like once it was below $2, I'm not going to pretend for a second I picked the bottom, but once it was below about $2, like this thing is it is too cheap. You only had to assume some sort of like mid to high single digit earnings growth to get value out of that.
I feel much more comfortable saying, oh, this has gone too far down when you've got a company that has a long history of dividends, positive cash flow, profits, all that sort of thing.
They pay a dividend, so it's a 3% yield. And by the way,
to an extent, I was playing devil's advocate.
I'm not
when I saw the sell down and the quitting and all that sort of stuff, I wouldn't go near it. Yeah. But yeah, I can definitely see it's one for putting on your watch list.
I was nervous too, man. But it gets to a point where you kind of think, yeah, I get that. And I like to sort of go through a what if scenario. And you say, well, what if there are some concerns here? What if growth has stalled? What if when they do return to growth, that pace of growth is much slower? And you can sort of draw that line of reasoning out and still get to a point where it's like, you know what? That's not a crazy. That is not there's not a high hurdle here for me to get a decent return.
So what would it take for you to actually buy some shares yourself?
A bit of extra cash would help. That'd probably be the main thing, if I'm being honest.
So, but it's not your highest conviction idea, or it would be in your portfolio already.
Yeah, that's true. Although there are taxation considerations, so if I was to sell down some other stuff, so
it's just put out new information recently. That's that it's turning around. Matt loves his inflection points.
Yes,
he's talked about them before. If you're going to be optimistic and if you're going to try and make the buy case, which I'm not sure I would buy it. But
that's clear.
No, I'm not that against it. I was just playing devil's advocate. I think it's an interesting one. It pays a dividend, cash flow, software company. Yeah, there's a lot to like about it.
Like honestly, if you're a little bit bearish on the Aussie economy too, they're not going to feel that at all. It just makes no difference to what they're going to do.
Yeah, that's true. And the other thing is,
plus a weaker Aussie dollar is great for them, obviously.
If they're recovering, if they're turning things around, as you've painted, they've gotten some of their reseller agreements back in order. Blah blah blah. Yep. There could have been some shorter term issues that have weighed it down. Now it's pleasing the market again.
Yeah.
Perhaps if you would argue that it's back into an inflection point where it can start growing earnings again, because it is, I think, based on the most recent announcement.
Yeah, absolutely. The first half is going to be really strong. I mean, their pre-tax profit could be as much as 26% higher on their indicative numbers.
Yeah, so
26%.
Yeah, no, that's great news. So
a 30-year-old company.
Well, so look, I think I actually am a little interested, and maybe it is one to take a look at. It's definitely bumped up a few spots on my watch list.
Well,
because
look, I always welcome you as a sounding board, because sometimes we don't always align, and it's always the worst. The thing that we love as investors, but the thing that is terrible for us is confirmation bias. So my monkey brain loves it when you go, "Oh, Andrew, that's a great idea. I love it as well." But my rational brain loves it even more when you go.
We do indulge in a bit of confirmation bias.
We do. But my rational brain really likes it when you go, "Are you sure about that?" Because it does give you pause for thought. Anyway, mate, that is my pitch. Let's not go on too much about integrated research. What about Xref?
Yeah, so
what do they? The startup, big picture. What do they do?
So they basically do reference checking for big companies or big organizations.
Okay. When you say reference, so if I'm applying for a job,
yeah. So imagine that we're, I guess, the HR department, or we're trying to hire in a big company, and we might take quite a large number of interview candidates to the point where we want to actually check their references. And this can be a time-consuming process. And the old way, I guess, is like you call people and you email people, and it can be a lot of work. So I'm told, for the actual people checking the references.
For the HR department.
Yeah. So basically, this is outsourcing that, and Xref gets the individuals to basically take responsibility for getting their referees to fill out the relevant questions, and then and then Xref software makes them available to the HR department. So I guess it's a little more structured than perhaps you might think of reference checking, and it's, I guess, maybe a little less personal, less of a feel for it. But
Is that all it does? It seems really narrow.
Well, that is the core of what it does. It creates more efficiency for the actual HR department by getting this stuff done. And it does this at fairly low cost by having the software and the systems that are required to, I guess, automate the process of checking reference. So it's really an automation play. And then they go and charge those big companies an amount that's similar to the cost that it would be for the big companies to have someone going and checking these references. Now, I said it's not all it does, because even though that is the absolute core of it, the value proposition, there's also when you automate things and when you're collecting all this data and keeping it, there are also certain sort of synergies and benefits that come out over time. For example, hypothetically, you can reuse the answers from one reference check to another.
Oh, yeah.
Also, hypothetically, that is if it's within the same organization.
Gotcha.
And then hypothetically, in the future, the organization who's done those reference checks and has those references, somebody might not be right for a certain job that they applied for.
Yeah.
But when they're looking for another position, they've still got that data there.
Yeah.
So there's the potential for synergy, which is of course like a big sell for the company looking forward to how it's going to develop its product and where it could grow into.
Yeah.
But at the moment, it's basically just trying to automate that reference check process. It is quite simple and it is quite niche. And that's one of the biggest risks, if you ask me.
Okay.
Because, or more particularly, this was also in the write-up that Matt Brazier did, and he researched into this, which is basically there is some risk that the big HR software companies, so like Workday is the big one in America,
right.
They could start basically just
adding it as a feature
potentially.
Yep.
And, in Australia, probably some listeners are familiar with Elmo software, which I actually owned for quite some time.
Elmo, yes.
I sold out of that a little while ago. But, look, I think Elmo's a good...
I hear your risk. I hear what you're saying.
Elmo's a good company. These HR roll-ups are good companies. What Xref does is quite specific.
Mm-hmm.
But there are some advantages to being in a niche when you're doing a software product and an automation product.
You can just be really good at the one thing that you do, or the handful of things that you do.
And shareholders like myself are basically believing that they can succeed at that.
Yep.
And certainly their sort of sales growth implies that they're getting traction.
This is what I was going to add. Often when, I think from an investor's perspective, you approach a company and they offer a certain product or service. If you're not in that space, it can be very opaque. I've never had to do referee checks and all that kind of stuff. And so you're going, well, is it really that hard? And it's really hard to sort of understand the value proposition. But when you mentioned that you wanted to talk about this, I did a little bit of reading, and one of the things that really makes you sort of pay attention is the fact that since I think they did a reverse listing, wasn't it, in 2016? And in fact, even before then, they've got some numbers. The customer growth and the sales growth has been absolutely phenomenal. I want to say 100%. Like, they doubled their sales last year.
Yeah, so it's a little shorter. It's a little short of that, but it's in that vicinity.
So it was like, oh, that's interesting. My next port of call for a company like this is you go look at the 4C statement to the ASX, so their quarterly cash flow statement, and lo and behold, they're operating profit positive, cash flow positive.
Yeah, so although that is true, and that's something I really love to see, however, that is with the benefit of the R&D rebate stuff.
I totally hear you on that. Nevertheless, that looks pretty interesting. And where I'm going to, and again, I've just glanced at it, but what a couple of questions that I wanted to ask you on it was, one, the valuation has, we talk about integrated research coming way back from its highs. Same with Xref, right? So it hit 80 cents in late 2017, and they're about half of that today. And even despite that, they're still trading at around 10 times sales. So what is that another case of the market getting too carried away and coming back to more reasonable levels?
So that would be my guess.
Yeah.
I certainly wasn't buying at those very
Sure.
high levels. I needed to see more growth, and actually, what I really needed to see was evidence of some kind of inflection point. And I guess the inflection point that I see the company creeping up on is okay. I guess sure, I'm looking for something here, so maybe this is flawed thinking, but what I'm looking at here is if you just look at the receipts from customers versus the staff costs, which is the major expense in a sort of software
the chart
company.
you're talking about, yeah.
Yeah, so if you just look at that, then 5 quarters ago, the receipts from customers, which is the cold hard cash coming in,
Yep.
admittedly, so that doesn't always necessarily line up with revenue.
Yep.
But that was about half staff costs.
Yep.
And the most recent quarter that they reported is getting like really close
Yeah.
to reaching staff costs.
Yep.
And
those staff cost growth had really flat or plateaued, right? Or starting to really
well,
plateau.
not as much as I would like. So my biggest risk and my biggest concern with this company is like having researched them and stuff like that, fast-growing tech company, they've raised capital on the back of their share price strength.
More than once, right?
Yeah, but they've got over still 10 million in the bank. So
Yeah.
funding's not a major concern in the very near future, which is a good thing.
Yep.
But also, there's the risk of what I'll like forever now refer to as the catapult trap, where you're growing revenue and that's impressive, and
Yep.
you've got a great product, but you're also just like growing costs.
In other words, you're not
crazy.
scaling well. You're not scaling well. So this top line looks super impressive, but there's just nothing sort of being spat out for shareholders.
Yeah, well,
at the
it's
other
like
end.
whether you're actually whether you're whether the board level decisions, is there somebody on the board banging the table and saying we're trying to do this for the value of shareholders, or
Yep.
this like great, we've got traction, raise more capital, we can
Yep.
hire more people,
Yep.
have an office refurbishment,
Yep.
buy a foosball table, like all of that sort of
Yeah.
stuff. I don't know. I illustrated with the write-up with a picture of some sort of company celebration, which they're of course entitled to.
Sure.
But I always wonder when I see a company promoting how much like fun and celebrating and dressed
Yeah.
up and everybody is, because I'm like, okay, so
not cost focused, perhaps.
yeah, exactly. So that's a message they're perhaps telling for like trying to recruit more staff or whatever.
Well, that was interesting. You mentioned that was one of the things I was also going to ask you about. It was one of these scenarios where companies like to talk about their revenue, obviously, their revenues, and it's been growing incredibly strong, obviously. But because of the capital raisings on a per share basis, I think sales have been flat for a couple of years. Now I'm not going to say for a second that that's an automatic negative, because if you think about it, right, if let's say you and I have a business.
Well, to me, it sort of is an automatic negative, and then you might have reasons.
It's a red
why
flag.
It's okay.
Let's call it a red flag.
Well, I feel like that's harsher than automatic negative.
Oh, really? Okay. Well, I mean, a red flag is in, we need to pay attention to this. But it's interesting, right? So legitimately, and you see this with some of the most successful companies in the world. Like you want to talk about, I don't know, Amazon or Apple, or in the early stages, you have this incredible growth. How are you going to ensure that you keep growing and keep doing it? You can't do it all with 3 people. You need to increase your cost base. It's an absolute essential thing if you want to be a much, much bigger company.
Yeah, but at a certain point, you need to be able to show that you can grow revenue without constantly.
I
increasing your
100%
costs.
agree. I
So
100%. But
keeping
my only point is, just to finish, is that it needs to be something that you monitor closely. But I think it's dangerous and cynical to assume that just because costs are growing that it is always negative. Now you mentioned a company that I don't want to refer by name that hasn't scaled well to date, and so yes, the market is littered with examples where that hasn't happened, but. I was encouraged to see with Xref that they're actually making it seemed to be in their slide deck, a couple of clear slides here saying, actually, we've got the cost base pretty much in place here. From now on, we can scale. From now on, we can get to this EBITDA break even. I think management gets some pretty juicy options and whatnot if they can manage to hit.
Yeah, so they seem to
Some good
they
targets.
look so the founders did sell some shares a while back. They still own a huge an adequate chunk of the company, but still. I prefer it when
Do they own
management don't sell.
40%, like
A little under.
the integrated research founder?
Actually, close to, I think it's 37%.
There you go.
So that's a positive. There are a few negatives. There are a few risks. For me, it's one of those situations where it reminds me of Volpara back when nobody was looking at it.
Yeah.
So actually, what happened is Volpara listed at around 50 cents.
Mm-hmm.
I think at 50 cents, and I sort of was watching it from the get-go because it's sort of right in my wheelhouse.
Yep.
And at a certain point, it fell all the way down to about 30-something cents.
Yep.
When I actually bought shares, like 33 cents, I want to say.
What's that, a 40% fall? Yeah.
Yeah, and this just shows like, and it had been as high as like 60 or 70 before then. So it just shows how the attitudes can change around these software companies. It fell very, very low, and now it's like up to very, very high again. I do own a little of that, but I did sell it at like some of my shares at like above $1.20 or whatever.
Yeah.
And around $1, I think. But because these companies are pre-profit and potentially very fast growing, it's very hard to value them. So their share price can swing wildly.
Yeah.
So you've got one scenario where they show insufficient cost discipline. They don't track towards break even.
Yeah.
In which case, I think I would sell shares.
Yeah.
You got another scenario where like there's more founder selling that would break my tolerance for more selling there.
Yeah.
So there's a number of reasons why I'd sell it. At the moment, I'm just sort of watching and accumulating like I did back with Volpara at 33 cents. I was pretty nervous about that then as well. I bought a little shares and then I bought more shares at higher prices as they delivered.
Yep.
And that's what my intention with Xref would be. But with a market cap of around 80 million and with fast growth, with reasonably adequate funding, I could definitely see them actually having a multiples higher share price in the future if this is well managed, if management wins the support and the trust of capital markets, which is all a little bit unknown with just like not that long under their belt.
Yep.
It looks pretty attractive risk reward for me at current prices. I bought it I think my average price is just above 46 cents over a couple of transactions.
Yep.
So that's nice, and that's just sort of a start for me. And their quarterly will come out soon, so I'll be looking at expenses just as closely as I will at the top line and the commentary on that one.
Yeah, gotcha.
And ultimately, depending on as we get more data on the company, I'll basically assess it and either do nothing or buy or sell depending on how they're going. But what I'm looking to see is basically revenue and receipts growing much faster than expenses, so that you can sort of track a plausible line towards break even. Once they reach break even, the power is much more in their hands. They can try to raise capital if they want to accelerate growth. But they don't have to.
They're not relying on capital markets.
And that's the most important thing.
Nice pitch, man. I like it. It's definitely encouraged me to look at it a bit closer.
So let's get on to the questions. Andrew, how about you take the first one?
We've got so many, so look, apologies to any that we don't get to. We will do a follow-up, but we got a good one from Luke. He was basically saying one challenge he's grappling with is whether to sell, and he puts in brackets, for significant losses, poorer quality growth stocks which just haven't gone his way. So he's talking about Catapult, he's talking about MSL Solutions, a couple we talked about last week. In fact, a couple I have recommended. My hand is up for that. CCX, what's CCX?
I don't know.
I'm not sure. CCX and PVS as well. And he's basically saying, look, I've had these growth companies, they haven't gone the way I want. Is now the time to switch these for higher quality businesses, which he's saying he now thinks is cheap. And he's actually mentioned company here like Google and PayPal and
Reese.
Reese as well.
I assume that's Reese.
And I think SQ is Square as well. So a couple of these big sort of US technology companies. So he's basically saying, my internal monologue says, don't sell relatively cheap stocks in a downturn.
Okay, so what's the answer?
The other tells me to invest only in higher quality companies. I think it's a really, really, really good question. I think the hardest thing here is to reset your thinking and avoid a lot of these anchoring problems that we've talked about before. So a lot of the time we end up making decisions based on what our personal profit or loss is, when in reality the market doesn't know what you bought your shares for. It doesn't care what you bought your shares for. The only thing that matters is where to from here. It's a very, very difficult intellectual exercise, but I would say here, Luke, that, yes, it's always frustrating when things don't go your way, but the question here, we've said this repeatedly, is what was your initial investment thesis and is it clearly broken? Can you reframe a legitimate objective one at this point in time that makes sense? And if you can't, bite the bullet, absolutely, and make the transition. Silver lining, you get a bit of a tax loss. But more importantly, you switch horses midway through the race, and your jockey might be on a more of a thoroughbred than a dusty old nag.
So none of this could be interpreted as like directly asking Luke's question in the case of those actual companies. But I guess what I would have to say is that I see a psychological trap in what you see as contrarian, gutsy, I'm sticking to the thesis stuff. And it's because I've been there before, and it's because I've actually suffered through the pain of trying to sort of help other people through that as well.
Yeah.
And I think whilst there is a certain inclination to a bias, as it were, to sort of sell to stop the pain, which you need to be aware of.
Yep.
I think there's also a certain denial factor where you don't want to admit you were wrong.
Yep.
And people...
Very powerful.
Yeah, people really underestimate that one.
Oh,
and I think it really varies a lot on how prideful you are.
Yep.
So I think step one is if you can sort of tell everyone and tell your mates and tell your mum about this terrible investment you made, you're at least you're trying to put yourself in a psychological state to be clear-eyed. So if you actually make yourself suffer the hit to your pride, which is actually something I do quite a bit, is talk about my losers.
Yep.
And I've had people say to me, it's like, oh, you don't have to make a big deal about it. You know, we're trying to put you as you're an expert or whatever. Don't. And I'm like, well, it's sort of my own sake.
Yeah.
I want to just put that out there so that I remove pride from the decision-making process.
By the way,
as best as I can.
I am always super cynical. Whenever I meet an investor...
we obviously do for each other as well.
It's huge. It's a massively valuable process. I am always super skeptical whenever I meet an investor and all they talk about is their winners. I'm just like, I don't care if you're Warren Buffett or Howard Marks. I don't care who you are. You are going to have a litany of like horrible mistakes in your past, and you're going to experience them in the future.
So
those that are very candid about them are the better investors.
There's that one. Look, anyway, so I guess getting a little more specific, when you get in a situation where you're kind of having second thoughts of a company, I think most of the time if you really examine it hard, then probably your original thesis is long broken. And you're adapting it now. Now, it may well be that there's a new thesis that could be accurate.
As long as you're honest with yourself and as long as you're being objective.
Channeling Matt here, like if you sold it today, would you buy it back?
It's great.
He would definitely say that, I reckon.
It's a great heuristic. Yeah.
And so for me, that sort of thing has got me over the edge to sell quite a few times.
Yep.
And half the time I know by the time I'm asking Matt, hey Matt, do you think I should sell this stock that I'm down 50% on? He'll like sort of just say that to me and then I'll sort of sell it that day.
Yeah, right. Okay.
So I think that's something. I mean,
we can't obviously give Luke specific advice, but I guess the long and the short of it is approach it afresh.
So anyway, moving on to the next question.
I think we've probably only got time for one more.
All right,
Unfortunately,
I'm choosing
your choice.
So like we got a great email from Sean which had 3 questions, and we won't try to answer all of them today, but one of them was about he saw a tweet saying that emotional quotient is more important than EQ. That's emotional quotient is more important than IQ when it comes to investment outperformance. In other words, a good emotional temperament will trump intelligence investing. What are your thoughts on this?
Sean, I 100% think that EQ is more important. Look, it's one of those things. Like if you've got an IQ of 20,
in 2
you're
minutes,
going to have trouble doing. You're going to have trouble doing it, right? So you need to, but I don't think you need to be a genius to be a great investor. I think if you've got average intelligence, you have every potential to be a great investor. And the difference that separates you from others with the same intelligence who aren't is that emotional temperament. That is a huge advantage if you can hold your nerve when everyone else is losing their heads.
Well, I agree about that huge advantage. Holding your nerve is very important. Of course, working on your emotional quotient should be part of your strategy.
Yep.
But I also disagree that you can be a great investor if you have average intelligence. I can't remember Warren Buffett's quote on this, but it was sort of like, if your IQ is like 120, then it's no more value. There's no more value after that.
Yeah, right.
Yeah, that sounds about right to me. Okay, anyway, so moving on to the next question, though, because Sean had a few, and I really liked the second one. And I'm interested to see what you say, because I'm sure it'll be flippant, but try to be serious.
Okay.
What is your purpose or inspiration in investing? Is there a higher purpose that drives you?
Oh, that is a good question. I'd like to say yes, but no. I want to make money.
I knew you would say that.
I do. And now, and having said that, I don't want any harm to come from my investing.
Why do you want to
activity.
make money?
I'm trying to better my situation. I'm trying to better that. I think money
You
is.
can at least make that sound better by being like your family situation.
That they can look after themselves. This is about me, Claude. No, I think.
Andrew's like, I want a boat and.
I don't even want a boat.
Right.
I've got very low requirements as a person in terms of creature comforts. So for me, I think that unless you have a goal to beat the market, there is zero, unless you get an inherent value in just the very process and you enjoy investing for its own sake, there is no point whatsoever in investing if you don't beat the market. And the reason I say that is because you can basically buy an index and do nothing. You know, it's the easiest thing in the world. You outperform most of the experts. It's just a no-brainer. So if you're going to do this, you need to do better than the market. Otherwise, it's a waste of time. And so my goals are to beat the market. And I really enjoy the process too.
There you go. Well, that's nice. Maybe see,
but I'm here for the money, my
I'm
friend.
going to teach you how to make that sound better, mate. But like, oh yeah, I want to better my family, and also it's like my calling.
Yeah.
Anyway, but for me, well, maybe it's just that
it's probably a giveaway in the website that you run is that you've got a more noble take on it than me.
The way I actually even started investing is originally I was working in renewable energy, but then I realized that it was going to be hard to keep my job. Once my company folded because the Prime Minister changed, and it's a bit of a soccer ball, that whole industry.
Let's not go down that rabbit hole.
Yeah. Anyway, so it's a bit of a tough one. And so I'd actually been investing sort of the whole time, but without making it my 100% focus. And so I thought, look, I think the problem for some companies is that they don't have enough people interested in investing in them, and so I'd be like an ethical investor, which doesn't have any sort of fixed definition. It just means that I think about whether I like what the company is doing, as well as whether I can make money out of it.
Totally fair enough too. Yeah.
And there's no like precise rules. I've bought companies in the past that I wouldn't buy today.
Yeah.
Maybe in the future I'll buy companies that there's companies that I've sort of changed my view on.
Yeah.
You know, I actually used to be really all for salmon farming.
Yeah.
And now I'm not at all for salmon farming.
From the ethical standpoint. Yeah.
Yeah, or even from a consumer standpoint. Farmed salmon is everywhere.
See,
I guess it's a different story, but I don't like to eat it much anymore. I still eat it.
It's interesting, you know. I would like to tell you. Let's give a really polarizing example. I would like to tell you that I would never invest in a tobacco company. Having said that, and there's none on the ASX that I'm aware of, but having said that, if there was an opportunity I thought was a very, very strong investment case, I don't know if I could hand on heart say I would avoid that for the ethical dimension. That probably paints me in a very bad light. But for me, this is a financial endeavor. But you know what I mean? For me, that is primary. But if I can layer that with ethical considerations,
that's totally legitimate.
It's a positive.
It's there's no one right way to invest, nor is there a right way to live your life. There's many good ways to live your life.
Look, we started by thinking, well, without Matt, this is going to be like 20 minutes, and we've gone longer than Matt is here. He's
the one that keeps us on time.
So I do apologize for that. I hope you have found it valuable.
And thank you for listening.
Thank you very much for listening. Remember, as always, you can reach out to us on email, threewisemonkeyspodcast@gmail.com. You can find myself, you can find Matt, you can find Claude, all on Twitter. We'll put all the links in the show notes if you want to get in contact with us, and we really appreciate it if you do. As always, we'd encourage you to give us a bit of a like or a good review on any of the platforms that you are using. It helps us spread the message.
And thank you for listening. Thank you for all the people that have written in, and
we love it.
Yeah, it's really keeping us going.
Well, otherwise it's just us talking to ourselves. So we do appreciate it. But we will wrap it up. Thank you very much. We'll be back again next week. We'll have Matt back in the saddle to keep us on time. But until then, happy investing.
See ya.